Okay, let's just jump right in. The date is February 26th, 2026. Right now, the entire global economy seems to be in the grip of a market rally that's unlike anything we've ever seen before, and it's all being powered by one thing: artificial intelligence. I mean, the numbers are just staggering. The optimism feels electric. But here's the thing. What if this isn't the start of some new golden era? What if it's actually the very peak of a massive, massive bubble?
So let's take a look at the board. On the surface, things look absolutely incredible, right? The S&P 500 is knocking on the door of 7,000. And just look at Korea's Kospi. I mean, it's surging past 6,300, driven by what this report is calling extreme investor FOMO. But if you look a little closer, you start to see some cracks. The US markets are actually down today. Big tech is feeling some serious pressure. And notice the US 10-year Treasury yield is falling. Now that means investors are buying up bonds, which is a classic flight to safety. See the contradiction? That's really our starting point for this whole conversation.
And that really brings us to the central question of this whole explainer. We're seeing these record highs, we're all celebrating this amazing AI-powered future, but could this relentless optimism be hiding a deep, fundamental risk to the entire system? This analysis we're digging into today suggests the answer is a big yes.
To really understand why, we're going to break down the argument into 4 key pieces. The report highlights 4 big economic ideas that are kind of like cracks in the very foundation of this AI boom. And each one of them points to the exact same conclusion. This spectacular rise might be built on dangerously unstable ground.
So, that first crack is a concept called malinvestment. It's an idea that comes from the Austrian School of Economics, but it's pretty simple. When money is super cheap and credit is way too easy to get, it just gets thrown at bad ideas. Capital gets poured into these massive projects that don't have real sustainable demand. And that always ends in a bust. The argument here is that right now, AI infrastructure is the greatest malinvestment in history.
And the scale of this is it's hard to get your head around. Get this number, $50 billion. That's the reported investment Amazon is planning to pour into OpenAI alone. It's an absolutely staggering figure, and it's a perfect example of this speculative frenzy that's being driven more by a fear of missing out than, a clear path to actually making a profit.
Okay, the second crack is something called the productivity paradox. And the main insight here from economist Simon Johnson is that technology isn't automatically good for the economy. Look, if AI is used to create entirely new jobs and new tasks for people to do, that's great. But if it's just used to automate and replace existing workers, you eventually destroy the very people, the consumers, who buy your products.
And this isn't some abstract theory. This is that paradox happening in the real world, right now. Block, a huge fintech company, laying off 4,000 people. That's nearly half its staff, and they're explicitly saying it's because of AI automation. This is not a future problem. It is happening today. And the CEO's prediction that most companies are going to do the same, well, that's a pretty chilling sign of where the real economy might be headed.
So here's the crucial point. We are living in a two-speed economy. On one side, you've got the financial world. Stocks are soaring, tech investments are at record highs, and corporate earnings look great on paper. But on the other side, you have the real world for everyday people. Unemployment claims are ticking up, consumer confidence is falling, and now we have the threat of global trade wars. The two are literally moving in opposite directions, and that just can't last forever.
The third crack isn't purely economic, it's about social mood. The theory here is that a really negative public mood often comes right before a major market downturn, and you can see the signals pretty much everywhere. A huge resignation at the World Economic Forum, lawsuits against big tech for addiction, government crackdowns on student loan companies. There's just this deep and growing distrust in the very institutions that are supposed to run our world.
So with all this pressure building up, what could actually set it all off? Well, this number, 15%, could be the trigger. The Trump administration has brought back a little-known part of a 1974 Trade Act to put a blanket tariff on all imports. A move like this could ignite a global trade war, completely disrupt supply chains, and send inflation through the roof.
And this isn't just theory and guesswork. Quantitative models are flashing bright red. This report points to a model that, after you plug in the new tariff data and all the other economic indicators, calculates an 84.7% probability that the market shifts from its current expansion into a full-blown bubble collapse before the end of the third quarter. So, how does this all come together into a specific forecast? Well, with all these underlying pressures, the analysis lays out a pretty clear timeline for how the rest of 2026 could play out.
Think of it like a two-act play. Phase 1, which we're in right now through about May, is the final euphoria. One last big surge as the AI hype from giants like Nvidia and Google just hits its absolute peak. But then, starting this summer, comes Phase 2, the great reversal. This is when the reality of all that malinvestment, the job losses, and the tariffs finally hits home. And when that happens, the market sentiment could flip violently from greed to fear.
So, what would this great reversal actually look like around the world? It's not going to be the same everywhere. The shock waves are predicted to hit different financial centers in some very specific ways. Let's start with the currency markets. The analysis sees the Japanese yen getting a lot stronger as global investors look for a safe place to park their money. On the flip side, the Korean won, the Chinese yuan, and the euro are all expected to weaken against the US dollar as they get hit by trade shocks and their own internal economic problems.
And in a world filled with this much uncertainty, where does capital run to hide? Well, to the oldest safe haven asset there is, gold. The report forecasts a supercycle for gold, with a year-end price target that could surge all the way to $5,500 an ounce as investors just try to find some shelter from the storm.
Back in the US, the forecast is pretty grim. The tech-heavy NASDAQ is predicted to fall into a bear market, and that's a drop of over 20%. On top of that, inflation from those tariffs will likely push bond yields higher, which causes even more pain for stocks. And you'd see a scramble in the derivatives market as the big players rush to buy protection against the downturn.
The report really identifies Europe as getting hit the hardest by these proposed U.S. tariffs, potentially tipping the entire continent into a full-blown recession, and that would probably force the European Central Bank and the Bank of England to start aggressively cutting rates to try and soften the blow.
Now, for China and Hong Kong, the story is more about a long, painful stagnation. Their existing problems with deflation and weak consumer spending will just get worse because of U.S. tariffs and the ongoing tech war. So the forecast here isn't a sudden crash, but more of a long, slow grind down with no real recovery in sight.
And that brings us right back to Korea's Kospi. The analysis here is really blunt, calling its incredible rally a meme-driven, irrational bubble. It predicts a painful correction, a reversion to the mean, that could see the index fall all the way back to the 5,000 level, as all that retail FOMO that drove it up suddenly turns into panic.
So, what is the ultimate takeaway here? What does this convergence of economic theories, social mood, and hard data really mean for all of us? Well, the report's final warning is a pretty powerful one.
And here it is. The final warning is this: we aren't just in another bubble. The analysis concludes that we're at the peak of the most sophisticated malinvestment in history. It's a really unique moment created by the fusion of two incredibly powerful forces, a decade of essentially free money and a blind, almost religious faith in the power of AI.
And that leaves us with one final and, I think, crucial question to think about. In this new age of artificial intelligence, as we're all chasing these incredible technological dreams, what value do we actually place on real-world fundamentals? Things like jobs, consumer demand, and profitable business models. The answer to that question might just determine everything that happens next.